Welcome to vTalkInsight, Allocator's Lens Daily for December 10th, 2025. Cross-asset markets are juggling resilient United States growth, rising global yields, and an AI-powered equity story, all into a pivotal stretch of Federal Reserve communication and inflation data. Today, the focus is how that tension is reshaping risk and reward across equities, rates, credit, currencies, and commodities. In equities, the big picture is that index levels still look strong, but the foundation is getting more fragile as rates back up. The S&P 500 has slipped slightly from recent records while the VIX index has ticked higher, matching reports that rising yields and a more hawkish tone from major central banks have started to chip away at risk appetite. At the same time, positioning looks stretched in pockets. Elevated single stock call option activity and higher margin debt point to a speculative layer on top of the underlying earnings story, while institutional participation is described as relatively thin. Protection has become cheaper, with the cost of downside hedges sitting well below the highs of the year, which suggests markets are priced for a smooth ride into year-end and could be vulnerable if the news flow disappoints. Underneath that, the growth and earnings backdrop for equities still looks supportive. Above-trend United States activity, helped by fiscal stimulus and heavy AI-related capital spending, sits alongside forecasts for low double-digit earnings growth, especially in technology. Commentators see the AI-driven upswing lasting several more years, with expectations that earnings broadening beyond the early megacap leaders will create a more durable base for the equity market. The consumer picture is similarly nuanced. On one side, strong travel volumes, robust holiday sales projections, and rallies in consumer names from discount retailers to department stores indicate confidence in demand. On the other, guidance from companies like Home Depot and reports of shoppers trading down and focusing on bargains show that price sensitivity and pockets of fatigue remain. That mix aligns with a soft landing narrative, but it also means earnings dispersion across consumer-exposed names is likely to stay high. AI continues to dominate equity leadership, but in a more complex way. Chip makers such as NVIDIA and peers have gained as export rules ease enough to allow sales of advanced, though not absolutely cutting-edge, processors into China, potentially unlocking tens of billions of revenue over time. At the same time, regulators in Europe are tightening scrutiny on big tech business models and AI deployment, which could weigh on valuation for the largest platforms even as demand for compute and software remains strong. Beyond AI, sector rotation is notable. Retail giants are repositioning themselves as technology-enabled platforms. Healthcare names like CVS are pivoting narratives away from traditional retail, and European wind and defense stocks are benefiting from policy shifts and large fiscal packages. Media and streaming are in the spotlight with a contested takeover battle, where potential large synergies also imply substantial restructuring and job cuts. The impression is of an equity market where idiosyncratic winners and losers matter more than simple index exposure. Against that constructive medium-term backdrop, several near-term risks stand out for equities. Rising global bond yields and a sharp pullback in the amount of Federal Reserve easing price for the next couple of years reduce the room for multiple expansion. Markets look complacent around upcoming inflation and payroll releases, the Federal Reserve decision, and stock-specific events like Oracle's earnings, all of which could jar expectations if they challenge the soft landing or easy policy narrative. On top of that, crypto markets are increasingly acting as an early warning indicator for risk assets, often rolling over ahead of broader corrections. With speculative leverage visible in both equities and digital assets, allocators may want to pay close attention to cross-market signals into year-end, especially if volatility in options and crypto starts to rise from today's relatively subdued levels. Turning to rates, the story has pivoted toward fewer cuts and higher front-end yields. Fresh United States labor data, from job openings to private payrolls and jobless claims, point to a market that has stabilized and may even be re-accelerating after wobbling earlier in the year. Some analysts argue the rolling recession in parts of the private sector has already played out, which reduces the urgency for aggressive easing. That resilience has fed directly into pricing. Markets that only a few months ago expected a much larger cumulative cutting cycle now see something closer to 0.75 of a percentage point of Federal Reserve reductions by 2026, and consensus for 2026 has drifted toward just a single quarter-point move. 2-year Treasury yields have pushed up to their highest levels in several weeks, underscoring that investors are demanding more compensation for policy and inflation uncertainty. The upcoming Federal Reserve meeting is central to this repricing. A cut at the next decision is still widely assumed, and communication suggests the committee may acknowledge that policy has moved closer to neutral rather than being overtly restrictive. However, several observers expect officials to stress a high bar for additional easing and to emphasize their dependence on incoming labor data before committing to further moves. There's also a sense that internal disagreement is deeper than the headline numbers will show, with only one open dissent likely, but more quiet opposition beneath the surface. That raises the risk of a so-called hawkish cut, where the policy rate edges down but projections and press conference tone push back against hopes for a swift easing cycle. Globally, a less accommodative stance from the European Central Bank and the Bank of Japan, together with the Reserve Bank of Australia, reinforces the move toward higher for longer yields rather than a synchronized global cutting wave. Beyond the policy rate path, liquidity and fiscal issues are shaping the curve. Pressures in money markets, with the effective funds rate edging toward the interest paid on reserves, hint that the Federal Reserve may soon need to add liquidity to prevent conditions from tightening inadvertently. Plans to gradually expand the securities portfolio and increase Treasury bill purchases later next year would push in that direction, but there is concern that the scale could prove too small if reserve balances keep shrinking. Fiscal and political drivers are another layer. In the United States, a pending Supreme Court ruling on tariffs could worsen deficits if revenue has to be refunded, while new tariff threats and inconsistent trade and budget policies add to term premia. In Europe, political deadlock in France is raising questions about budget approval and long-term debt sustainability, even as Germany embarks on a large defense spending program that supports growth but adds supply. Forward curves, including expectations that short-term reference rates drift toward roughly 3% over the next year as inflation cools, sit at the center of these cross-currents and will be key for equity and credit valuations. In credit, the message is that carry remains appealing, but the margin for error is thin. With policy rates still elevated and corporate fundamentals generally resilient, all-in yields in investment-grade and high-yield segments are historically attractive compared with much of the past decade. Some strategists describe fixed income broadly as well-positioned for 2026, helped by above-trend growth tied to AI and infrastructure spending. Yet spread levels themselves are tight. Commentators warn that compressed risk premia leave little compensation for taking on additional credit or liquidity risk. Any deterioration in the macro outlook or a policy surprise that pushes yields higher could quickly widen spreads from these levels, particularly in lower quality segments, turning what now looks like a benign backdrop into a more volatile one. Outside public markets, private credit is drawing significant attention. Pension funds, insurers, and other large allocators continue to increase exposure, reflecting confidence in the asset class's return profile across cycles. At the same time, regulators are under pressure to subject private credit to more rigorous stress testing after recent bankruptcies, and officials appear less inclined to offer future rescues in areas that have already benefited from support in past crises. This combination of rapid growth, complex structures, and a thinner perceived regulatory backstop is raising questions about how private credit would behave in a genuine downturn. It also intersects with a broader boom in private markets, where assets under management are projected to climb sharply and secondary markets are expanding to provide liquidity in an environment of longer holding periods and delayed public listings. At the issuer and sovereign level, several flashpoints stand out. In corporate credit, large acquisition financing, such as a potential multi-tens of billions bridge loan to support a media deal, could materially increase leverage at the acquiring firm and pressure future cash flows. Earnings from companies like Oracle are being watched for signals on how credit investors perceive sector-specific risk versus relatively calm equity volatility. In Europe, fiscal tensions in France are raising concerns that deficits and social security shortfalls could translate into further rating pressure and higher funding costs, while Germany's sizable defense and infrastructure commitments may support domestic issuers tied to those themes. For multi-asset allocators, the key is that despite tight index-level spreads, dispersion across public, private, and sovereign credit is growing and may offer as much risk as opportunity. In foreign exchange, expectations for the United States dollar are relatively subdued. Surveyed views suggest that, absent a major growth outperformance by the United States versus the rest of the world, the dollar is more likely to trade sideways than to embark on a new structural bull or bear market. That assumption leans heavily on the idea of gradual convergence in growth and inflation across major economies. Policy divergence still matters, though. A Federal Reserve that cuts slowly, while the European Central Bank and Bank of Japan lean a bit more hawkish, could generate episodic volatility in dollar crosses, especially if markets are forced to reprice the pace of easing. That interaction between relative rate expectations and currency moves remains an important input for cross-border returns and for corporates with global revenue exposure. The more dramatic action is in digital assets. Bitcoin has rebounded toward the mid-90,000 level after a bout of profit taking by long-term holders, with new demand increasingly coming from institutional investors rather than retail. The launch of exchange-traded products, clearer regulatory frameworks, and macro pressures have all contributed to the perception that crypto is becoming a more established part of diversified portfolios. Stablecoins are expected to grow rapidly as well, with forecasts of market capitalization potentially doubling on the back of regulatory clarity, official support, and adoption by technology platforms and users in emerging markets. Some asset allocation commentary now talks about mid-single-digit or higher portfolio weights for crypto in certain investor segments, underlining how far the asset class has moved into the mainstream compared with prior cycles. Even as it becomes more institutionalized, crypto retains its role as a high beta sentiment gauge. Recent experience suggests that sharp downturns in digital assets often precede broader risk-off moves in equities and credit, especially when markets are crowded in speculative trades. That makes crypto price action and funding conditions a useful, if noisy, early signal for shifts in overall risk appetite. For allocators, the interaction between cheaper equity volatility, rising leverage in both traditional and digital markets, and a growing base of long-term crypto holders creates a complex feedback loop. Monitoring how crypto reacts to key events such as the Federal Reserve decision, inflation data, or regulatory headlines may provide additional insight into where broader cross-asset stress could emerge. Commodities add another layer to the cross-asset picture. Precious metals have seen an interesting rotation, with silver prices breaking to new highs and outpacing gold. That shift may reflect changing preferences in how investors hedge inflation and policy risk, or a view that silver's industrial uses offer more leverage to an eventual upswing in growth and green technology demand. This comes as broader commodity equities, particularly basic resources and oil names in Europe, have underperformed on recent price weakness and sector-specific challenges. Together, these moves suggest investors are being selective about where they seek commodity exposure, favoring areas linked to structural themes over more cyclical plays. Trade policy is a significant swing factor for agricultural and industrial commodities. The United States' decision to allow certain advanced chip exports to China has been linked by some observers to efforts to secure increased Chinese purchases of agricultural products like soybeans, underlining how technology and farm goods are being traded off in negotiations. At the same time, threats of new tariffs on inputs, such as fertilizer and staples like rice, raise the risk of renewed disruptions in key food supply chains. Retaliatory measures have already weighed on United States agricultural exports in recent years, and import sourcing has shifted away from China towards Southeast Asia as firms rewire supply chains. While this reduces direct exposure to China, it does not eliminate dependence on broader Asian manufacturing and logistics networks, leaving commodity flows sensitive to further tariff and regulatory changes. Energy markets are being reshaped by both AI and the broader electrification trend. Projections now point to United States electricity demand growing several percent per year for decades, a marked break from the stagnation of past years, driven by data centers, electric vehicles, and industrial electrification. Companies are responding with innovative solutions, from repurposing assets linked to prior crypto mining to developing high-efficiency gas turbines specifically aimed at powering AI infrastructure. On the policy side, Europe is combining defense and transition themes, with Germany planning a record defense procurement package and courts clearing obstacles to offshore wind projects, which has boosted names like Vestas and Ørsted. Fragmentation and deglobalization are encouraging governments to deploy larger fiscal packages into infrastructure and energy security. For multi-asset portfolios, that means commodities sit at the crossroads of geopolitics, climate policy, and the AI investment cycle, and are likely to remain a key driver of regional and sector performance. Stepping back, the cross-asset picture is one of robust growth and powerful AI and fiscal tailwinds colliding with a tighter, less forgiving policy and valuation backdrop. Equities still lean on an investment-led expansion and strong earnings expectations, but higher front-end yields, speculative leverage, and growing dispersion between winners and laggards increase the odds of sharper swings around data and policy events. Rates markets have recalibrated toward fewer Federal Reserve cuts and higher for longer yields, while credit offers attractive income with limited spread cushion and rising complexity in private markets. In currencies and crypto, the base case of a broadly stable dollar contrasts with an increasingly institutional digital asset ecosystem that may signal turns in risk sentiment. Commodities tie these themes together through trade tensions, the energy transition, and renewed defense and infrastructure spending. Into the upcoming inflation releases and Federal Reserve decision, allocators may want to watch how equity volatility, credit spreads, crypto prices, and key commodity benchmarks respond in tandem, as those relationships will help reveal whether the late cycle, soft landing narrative is consolidating or cracking. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.